that we're going into an era of much lower returns than we've been accustomed to in the past.
Expect the next 10 years to have lower returns in the equity markets than the last 10?
The answer is yes.
Nowadays, the structure of the markets and where everything is priced will give you a return in the vicinity of 4% with a lot of risk around it.
The great investors of our time talk about the next 10 years as a lost decade in the stock market. The exciting part, all three have different explanations as to why it will be a lost decade. If you stay tuned to the end of the video, you will learn how to prepare for the next 10 years in the stock market and what advice the most successful investor of all time, Warren Buffett, has for you to still profit in these 10 years. Enjoy the video. To understand the full extent of a lost decade in the stock market, let's go back. In July 1999, the greatest investor of all time, Warren Buffett, correctly predicted a lost decade in the stock market. He said, over the next 17 years, if I had to pick the most probable return from appreciation and dividends combined, that's 4% in real terms. And if 4% is wrong, I believe that the percentage is just as likely to be less as more. The reason for his assumption is simple. He saw that the entire stock market was way overvalued. Buffett based his assumption of an overpriced stock market on a look into the past. A look at two time periods that could hardly be more different. Let's take a look at the historical chart of the S&P 500. The first period begins in 1965 and ends in 1978, during which time the S&P 500's gains danced constantly around zero. In contrast to the 0.1% return the S&P 500 brought in, the US GDP grew by a hefty 9.3% per year. In biblical terms, there were 13 lean years despite rising corporate profits and a growing US economy. A lost decade. After that, the second period began, which started in 1978 and lasted until mid-2000. Despite 3 recessions during this period, there were 22 years of exceptional returns averaging over 13% per year, and this even though US GDP only grew by just under 7%. This period of fat years in the stock market, also called the boomer bull market, was to set up another lost decade in the 2000s. Buffett warned of the upcoming lean years in 1999, shortly before the end of the fat years. Later I will tell you which 3 key factors Buffett used to determine whether a market is currently overvalued. Also at the end of the video I'll tell you if the 1999 forecast of 4% returns over the next 17 years was accurate. Now we come to the warnings of 3 other investor legends. We start with Jack Bogle's oldest forecast from 2017 and then move on to Munger's warnings in 2020 and Ray Dalio now in 2022.
It seems pretty clear to those of us who are expert, who may know nothing, never forget that we're going into an era of much lower returns than we've been accustomed to in the past. How that will play out, nobody knows. I would be in the camp of saying the market is significantly, not grossly, but significantly overvalued. And assuming that's correct, there are only 2 things that can happen. You can have a long period of very low returns, or a great big drop in the market, 30%, 40%, even 50%, and then get back to the good returns of the good old days. That's a hard way to do it. But it seems almost inevitable that returns will be lower somewhat than this 35 years or so that we've had the greatest bull market in recorded history. So one of the lessons is, I think, is the trees don't grow to the sky. And I'm really quite confident about that.
Jack Bogle's premise here is that a period of exceptional returns is always followed by a period of low returns. And in this statistical phenomenon we are dealing with the regression to the mean, which is described by Jack Bogle as kind of law of gravity in the stock market, through which returns mysteriously seem to be drawn to norms of one kind or another over time. In other words, what goes up must come down, and what is down will eventually go up. In the next clip, Jack Bogle describes where returns in the stock market actually come from. He reveals his method for being able to estimate future returns in the stock market and what he thinks is a realistic return from 2017 to 2027.
And I divide the market, the market return, into its 2 sources. One is investment return, one is speculative return. What is investment return? Today's dividend yield plus whatever earnings growth we get in the future. It's averaged about 5%, could get to 6%, 6 or 7%. It can't really be much higher than that. And unless you get a depression, it's not going to be much lower than 2. So there's not a lot of room to differ there. The long-term average is about 5% earnings growth. So we take today's 2% dividend yield, and my guesstimate, gives us 6% investment return. The other part of it, which is the more troublesome part, is speculative return. And speculative return relates to valuations, which we can easily measure by changes in the price-earning multiple. If it goes from 10 to 20, that's 7% of extra return. And we got that in the 80s, and we got it again in the 90s. And we're not going to get it again, because PEs can go from 10 to 20 to 40, but I don't think they can go to 80, which would be required if you follow the math. Sorry to bother you with those numbers. So I believe that we will probably go, PE in the market is about 25 times today. And if it goes to 18 times, say, that's 6% that I gave you from investment return, take off 2 percentage points for the drop in the valuation, would give you about a 4% return in the stock market.
Jake Bogle assumes an annual average return of 4% per year from 2017 to 2027. Since the stock market and especially the American S&P 500 index has risen significantly since November 2017, he says we can expect much lower returns once again. If we calculate with 4% per year starting from November 2017, then the S&P 500 total return index would have to stand at 7,411 points in 2027. The problem is, in 2022 we are currently already at just under 8,000 points. That means there is no return left for the next years according to Bogle, unless the overvaluation of stocks increases further. But let's see what Charlie Munger had to say on the subject in December 2020, when the S&P 500 was at around 3,700 points, almost exactly as it is today.
Expect the next 10 years to have lower returns in the equity markets than the last 10. He doesn't
Yes.
give us an idea why.
The answer is yes.
And could you give us a hint as to why that might come to pass?
Yes, because so many people are in it and the frenzy is so great and the systems of management, the reward systems are so foolish that I think the returns will go down, yes. In real terms, the returns will be lower.
Munger hints at the fact that many new people came into the stock market in 2020 primarily through discount brokers. For example, Munger called the American trading app Robinhood a gambling parlor. The trading app which gained a massive amount of new customers during that time. And whenever the stock market feels like a casino, it's time to take a closer look at your investment decision. Do you invest out of emotion, out of fear of missing out? Or are you rational and see opportunities in what you believe to be undervalued stocks? Let's now look at the investment legend Ray Dalio, who spoke 4 months ago about the stock market returns over the next 10 years.
Nowadays, the structure of the markets and where everything is priced and done the normal way will give you probably a return in the vicinity of, with a lot of risk around it, maybe in the vicinity of 4%. Okay, something that might not equal inflation, probably it'd be very close, and then you have to pay taxes on it.
Ray Dalio's statements also sound similarly pessimistic to those of Munger and Bogle. Because even if there will be a return of 4% per year in the stock market until 2032, then investors could still go home with 0% in real terms. Because Ray Dalio suspects that inflation and taxes on investments could eat up all the gains. And according to Warren Buffett, that would mean it's not investing at all over the next 10 years. He says, investing is laying out money now to get more money back in the future. More money in real terms after taking inflation into account. And speaking of inflation, Ray Dalio reveals what current inflation and the Federal Reserve's rate hike means for investors now in the following clip.
What's happened is they produced a lot of debt and gave out a lot of money. And so everybody's got money, and it's also very easy to borrow money to buy things. And as a result, if you create much more buying power, then you create goods and services, you've got a lot much more inflation. And the Federal Reserve has been behind the curve, slower to tighten monetary policy. And as a result, we're now starting to see the rise in interest rates to be able to deal with that. As that happens, all assets compete with each other. So now that free money is still going to be cheap money, but it's going to be a bit higher. So interest rates, let's say bond yields, have gone up about 1%. Now you take that and you adjust, everything is the present value of future cash flows, but it means that that interest rate goes up 1%. That means all the other assets have to adjust. We're in a process of making that kind of adjustment. That means the days that we've had before, the easy days where they dump money on you and you don't have much inflation and you don't have much tightness, those are past. And now we're in a different kind of part of the cycle.
According to Dalio, the economic cycle is now at a new place. Rate hikes could mean the turning point and the start of a lost decade. For such a decade to be avoided for investors, at least one of three things must happen, according to Warren Buffett. First, corporate profits must rise more than in the past, because this would cause the price-earnings ratios of the companies to correct downward. Or the prices could adjust upwards to the increasing profits, because in the long run the value of a company is inevitably linked to its earnings, or as Buffett says, the inescapable fact is that the value of an asset, whatever its character, cannot over the long term grow faster than its earnings do. And here the question arises, is it realistic at all for the next 10 years that corporate earnings will grow faster than in the past? To answer this question, I looked at a historical chart of US corporate profits over the last 40 years. From 1982 till 2002, US corporate profits grew by an average of 6.6% per year. From 2002 to 2022, corporate profits grew by 7% per year. Even if there is a slight upward trend here, it is hard for me to imagine that corporate profits will grow by 8, 9 or 10% per year in the future. This would be possible, for example, through tax breaks for companies, but if we consider that many large corporations are world champions in saving taxes and pay little or no taxes anyway, that also sounds unlikely. The second thing that would prevent a lost decade would be falling interest rates. Because interest rates act like gravity, the higher interest rates go, the lower stock prices go. This is because companies have higher interest costs, therefore smaller profits, and many investors take the opportunity when interest rates rise and get out of stocks and into supposedly safe government bonds. Currently we are seeing again the trend towards rising interest rates. The interest rate hikes are used by the central bank to fight inflation. I don't see a trend reversal here for the next few years, but you can never be sure. And the third thing that can provide high equity returns over the next few years is, well, that is you. If you yourself pick the big winners out of the thousands of stocks on the market, then the market can go sideways as it wants, you will make returns. At a time when it's buzzing with technological innovation, blockchain technology, artificial intelligence, genome sequencing, robotics or new battery storage, I give you the following advice from Buffett, which is more relevant than ever. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and above all, the durability of that advantage. The products or services that have wide sustainable moats around them are the ones that deliver rewards to investors. So to achieve returns despite a lost decade in the stock market, it is necessary to select companies with large moats. These are companies that have an unfair competitive advantage over their peers. And for Buffett, that advantage must be long-lasting. Classic companies of Buffett with big moats are, for example, Apple, Coca-Cola or Bank of America. But if we take Coca-Cola as an example, it is not enough to choose such a company. The price must also be right. Whoever bought Coca-Cola shares in November 2000 at the peak of the bubble could, if we exclude dividends, wait until almost 2015 to get out of the red. So more than a lost decade. And in 2000, Coca-Cola's price-earnings ratio was whopping 79. So it was anything but cheap. Now the breakdown of Buffett's forecast from July 1999. He predicted that the US stock market would return 4% per year for the next 17 years. Look at the S&P 500, the largest US index. We take July 1999 to July 2016, 17 years. Then we take the inflation adjusted chart and get an annual average return of 1.4%. If we add the S&P's 2% dividend, we get a 3.4% real return. So Buffett is only 0.6% off with his 4%. What do you think about a lost decade in stocks and how are you currently doing in the stock market? Feel free to write it below in the comments.